Hello and welcome back to the Geordie Pig Investor channel. Today I'm going to be doing a stock analysis video going through is Burberry Group PLC stock a buy right now. So let's get on to the video. So what is Burberry Group PLC, ticker symbol BRBY? Well, it operates as a holding company, manufactures, designs and distributes apparels and accessories under the Burberry brand. The firm also licenses third parties to manufacture and distribute products using the Burberry trademark. The firm segment includes retail and wholesale and licensing. The retail and wholesale segment is engaged in the sale of luxury goods through Burberry mainline stores, concessions, outlets and digital e-commerce, as well as the Burberry franchise, department stores globally and multi-brand specialty accounts. It's a really reputable brand that not only has hubs within the UK and Europe, but also over in the United States. It's actually been around since the 1800s as well. So let's have a look at a few key stats. It is based in the United Kingdom. Its industry is the luxury goods. It has a market cap of over 4.4 billion. It first came onto the stock market in 2002. It currently has over 9,000 employers, has a dividend growth streak of just 3 years, but has a 5-year dividend growth rate of 8.74% and a healthy dividend yield of 5.25%. Over the last year, it has been on the decline a whopping 49%. So what we're going to do today is dive into the price, see if it's an attractive price right now, and if it is a buy, sell or hold. First off, let's have a look through what free cash flow is, and then we will have a look into seeing what Burberry's free cash flow is itself. So free cash flow is the money a company has left over after it pays for all of its expenses. It's really important to know and understand that free cash flow has a massive impact on the direction a company may be heading. Free cash flow is important because it's a good indicator for how healthy a company is and its potential to grow the business. Not only grow the business, but also pay a dividend or reduce debt. If a company has more free cash flow, then they're obviously able to be a lot more flexible, so they can make big moves without having to worry about borrowing money from their investors, and they've got the freedom to tackle whatever projects they want on their own terms. On top of this, if a company has a good free cash flow, then they can reward the shareholders by giving money back through the dividends, or they can potentially do share buybacks. Share buybacks usually lead to an increase in value of the remaining shares because they're buying shares off the company, off the market, so then there's actually less shares on the market, which increases the price. Finally, just want to say it's really a good sign to see that a company has more money coming in than going out. So if they've got a healthy free cash flow, that means there's more money coming in, and that's never a bad thing for a company to have. Burberry Group's free cash flow. So here's the chart on the left hand side showing exactly how a free cash flow is and how it has been over the last 10 years. Actually, since it dipped in COVID and went down to 220 million at the end of 2020, it has now increased right the way back up to an impressive 500 million in free cash flow. Although the growth hasn't been steady over the past couple of years, I still think it's shown very, very positive signs and it is moving in the right direction. Burberry also has a really nice free cash flow payout ratio of only 37%. This shows that they've got a good scope to increase those dividend payments and still have a healthy free cash flow payout ratio. The next model we're going to look at is a discounted cash flow valuation, also known as DCF. The discounted cash flow valuation is a method that estimates the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flows based on a selected operating model. The DCF valuation is one of two methods that we're going to use to value a stock. By having more than one method, it's going to help us have a more accurate analysis of the company. We're also then going to have a look at a third angle, which is something we'll get onto in a little bit later on in the video. Another way to be certain of my valuations is by having multiple valuations for each. So I don't just plug in numbers for one valuation. What I like to do is I like to plug in numbers which are a best case, an average case and a worst case scenario. So then we have a better margin of safety and then we can have a look across all three. Let's get on to seeing how Burberry Group's discounted cash flow actually is themselves. So their current price is 1,219 GBX, also known as £12.19. And after plugging in the numbers of a discounted rate of 8% and a terminal growth rate of negative 2.7%, you can see in the worst case scenario it's overvalued at 36% and is only worth 777 GBX. With an average case scenario being a discounted rate of 7.65% and a terminal growth of 0, you can see that the company is now undervalued by 33%, being valued at £18.08 And then finally, a best case scenario, it is going to be undervalued at 50%, because if we put in a discounted rate of 7.27% and a terminal growth rate of plus 2.7%, it comes out at being worth £24.20, which is actually double what it's worth right now. The next valuation to look at is relative valuation. This method is used to value a company by comparing it to other competitors based on certain metrics. The metrics it uses includes EV to revenue, EV to earnings before interest, tax, depreciation and amortization, and PE ratios. You can use multiple different metrics when working this out. These are the main three that I like to stick to when I work it out myself. By using this method alongside DCF model, we are then calculating something that's actually called the intrinsic value. The intrinsic value of a stock has been used for many, many years to calculate stocks, and is one of the reasons why I personally use it, as it is a proven method over the long term. A famous quote said by Warren Buffett was, "Price is what you pay, but value is what you get." Basically highlighting there's no good buying a really good stock if the price is too much. So you want to make sure that you're doing your valuations and making sure that the price is at an attractive one, so that you can get in at the right price and reap the rewards from that. Moving on to see what Burberry Group's relative valuation is. A quick reminder again, its price is currently 1,219 GBX. On a worst case scenario, it is actually undervalued at 24% at 1,614 GBX. The base case scenario, we came out with an undervaluation of 36% at 1,920 GBX. And the best case scenario came at undervaluation at just shy of 50%, being worth 2,386 GBX. So now we can put the two methods together and find out the intrinsic value by adding the two and then getting the average. So the worst case scenario on the intrinsic value is 1,195 GBX, average case being 1,864, and the best case being 2,400 GBX. Next, we're going to look at the third valuation method that I use, and that is the Wall Street estimates. The Wall Street estimates are an average estimate of a public company's quarterly earnings and revenues that lead to a valuation of the company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. So there's not only just one analyst for big companies such as Burberry, there's going to be multiple analysts who look at this company throughout the year and then come to a conclusion and decide what value it's actually worth. The Wall Street estimates are also known as earning estimates or earning expectations. And these are usually used by bigger brokerages before earning reports come out to predict what they think it's going to be worth. So what they'll do is they'll use the Wall Street estimates to see what their revenue should be, how much profit they should be in for that quarter. And if they were to hit their targets, then the likelihood is the stock's going to then go up in price because they've hit their Wall Street estimate price. But if it doesn't quite match what the Wall Street estimates had for their expectations, then there's potential that the stock might crash. Since I'm a long-term investor, I'm looking to hold all my stocks for over 10 years. I don't look to sell stocks very often, but if I do, or I feel I need to, it's usually due because I've got an over-allocation in a stock due to it being overpriced, which leads to me trimming down a position. Or if I'm just not happy with the direction a company is heading, if it's got a dividend that might be getting cut, or feel a company's free cash flow is decreasing in size, or the company is showing really bad earnings reports, then that would only be the only other reason why I would then sell out the stock. I want to be analysing and buying a stock with the intent to hold it for the long term. So that's really important here, because I'm not looking to buy these stocks in a dip and then potentially sell as soon as it goes up in price. I'm looking to buy the stocks in the dip and hold for the long term and reap the rewards over the long term and receiving those dividend payments. Now let's have a look into Burberry Group's Wall Street estimate. So in the worst case scenario, they're worth 1,010 GBX. Average case was 1,394 GBX. And the best case, they predicted it would be worth 1,746 GBX. Bearing in mind that is all over the next 1 year valuations. So now I've got all three valuations. What we'll do is we can combine the three, have a look at the average and bring up the best, average and worst case scenarios for each of the three prices. And then I can have a look and see how much I believe the company is worth. So the worst case scenario, it has actually been valued at £11.33. So if I was to use a 10% margin of safety on this, you'd be looking to buy it around about £10.17. And if you wanted to use a 20% margin of safety, you'd be looking to buy it about £9.07. The average case scenario, they believe that Burberry is worth £17.07. So by using a 10% margin of safety here, you'd be looking to buy it around about £15.36. And with a big 20% margin of safety, you'd be still comfortable to buy at about £13.66. And my best case scenario comes out at £21.84, meaning with a 10% margin of safety, you'd be looking to buy about £19.66, and with a 20% margin of safety, the best case scenario, you'd be looking at buying at £17.48. So what does this mean? Well, I think the company is showing enough promising signs for myself to see the value at this current price. I'm not going to be blowing the bank on it, but if the price hovers around about that £11 to £12 mark and it's paying that really solid 5% dividend yield, I'm happy to buy into the stock at this price. And by using that 20% margin safety on my average case scenario, we could be buying right the way up until £13, and I'd still be comfortable if it was at this price. So with this information, I will continue to potentially buy into this stock, and I do believe it is at a very, very good price. What's your thoughts on the stock? Do you think it's at a good price? Is this a company that you're looking to potentially open a position up in, or is it a company you've already got a position in? Let me know in the comment section down below. I hope you've enjoyed the video. Please let me know of any other stocks you want to see a breakdown video on. And like and subscribe to the channel would mean a hell of a lot to me, so please do so. Thanks for watching, and this is the Geordie Pig Investor, over and out.